So we're still on departmental records. We start with activity 1. Auto parts has 2 departments, a new car sales department and the service workshop. The following were in the books at 30 November 2016. So we have 2 departments there. So we are told to prepare at the end of the year, okay, we're told to prepare a statement of profit or loss and other comprehensive income for the year ended 30 November 2017 to show the gross profit. And gross profit is always cost of sales minus cost of sales. So we're going to start with the first department. The first department is new car sales and the second department is service department. So the new car sales has its revenue to be 870,000. That's for new car sales, and service department has its revenue to be 120,000. Done. Then we have our opening inventory. We had opening inventory. That's part of, we had our opening inventory, which is new car sales 130,000 and service department 20,000. The purchases, we have purchases based on the items of our statement of profit or loss. We have purchases for new car sales, which is 420,000, and for the service department we have 80,000. Done. Then based on, we have to check the additional information. There's transfer. Go to the third additional information. During the year, inventory up to the value of 5,000 was transferred for use in the new car sales department. So the new car sales department, it will be added to the new car sales department. That's 5,000.
Transfer and debit.
Right, transfer. New car sales department. You debit the receiving account
Yeah.
department. You credit the giving department. So crediting the giving department means you are minusing it from that department. So 5,000 will be added to new car sales transfer, and 5,000 will be deducted from service department.
Yeah.
I think that is clear. The first additional information is done. Then the second one, we have our closing inventory, which is closing inventory for service department was 20,000. For service department is 20,000, and for new car sales is 125,000. So you less closing inventory from service department, which is for service department, which is 20,000, and you less closing inventory for new car sales department 125,000 is there. Then those are what we have to add together. Then we take it away from our cost of sales. So here our cost of sales will be opening inventory plus purchases plus transfer or minus transfer, less closing inventory. That will give us our cost of sales. So for new car sales department, our revenue is 870,000. Opening inventory is 130, purchases is 420. You add it together. Transfer is 5,000. You add it together. Then you less closing inventory. So opening inventory plus purchases plus transfer minus closing inventory gives us our cost of sales.
Okay.
So cost of sales will be 870 minus the addition of the revenue minus the addition of cost of sales, which is 430,000. So the gross profit for new car sales department is 440,000. Then for the service department, we have inventory 20,000 plus purchases 80,000 minus 5,000, which is transfer because it's credited.
Yeah.
Then we have closing inventory, which is 20,000, which has to be debited, which has to be deducted. So the total gives us 75,000.
Yes.
So 75,000 minus 120,000 gives us 45,000. So the gross profit for sales department, new car sales department is 440,000, and the gross profit for service department is 45,000. I think that is clear.
Yeah.
So that takes us to activity 2. Yes. For activity 2, I'll be right back. Okay, we'll go on to activity 2. They said case study expanding or closing the department. We talked about that anyway. So they said from the list of factors above, which we had already read, draw up an evaluation table showing the possible advantages and disadvantages of closing the department. So now you are evaluating. You want to know why you can maybe close the department or not closing down the department. So evaluation is simply talking about making decision. So if you are evaluating, it means you want to decide if, based on, we talked about in the trade-offs, we talked about weighing up. So putting on information, gathering information to decide if you are taking this decision, making this decision or not. Same goes to expanding or closing the department. So here they said from the list of the factors which we already have, the consideration you have to put into what you have to put into consideration when you are when you want to decide closing or shutting down. So from that list, we want to evaluate the advantages and disadvantages of expanding, advantages and disadvantages of shutting down. Yeah. So we're going to start with The advantages and disadvantages of closing a department. So the first thing I wrote, it increases profit as the loss-making department is shut down. So the point I'm making is this: because we are closing down a department that is not making profit, it means the cost on that department is reduced in terms of wages that has to be paid, in terms of maybe wages that has to be paid, in terms of salaries of managers that has to be distributed, in terms of other things that that department will be needing. So we won't be paying that anymore, and that might increase our profits.
Okay.
That's the first point. The second one, it allows expansion in other areas that could increase profit. So because we are shutting down that department, we might use that department
To add extra.
to the amount of what we are supposed to be spending on that department. We can now spend it on departments that are profitable. That will increase their productivity and as well profit. Clear? Is it clear, please?
Yeah.
Income can be generated through leasing the empty space. It's an empty space now. We can lease it to some businesses or other companies.
Yeah.
So they start using it and they give us rent income.
Yeah.
So we can generate income through that way too.
But maybe it's one building and each building is separated into different floors. Why would they rent each the floors out?
They can. To a company, it happens. Well, because most of the time you don't see that here. In Nigeria, we have a whole building, occupied by different businesses.
What if one business owns the whole building, each department, and one business rents out one floor? Is it okay?
It's okay. As much as what they do is not disturbing the others.
Okay.
So it's possible. So that's why sometimes in your statement of financial position, you will see rent. You have rent income and you have your rent.
Yeah.
So your rent income, you are paying for rent. It will be in expenses, and your rent income will be on the other side.
Right, yeah.
Because it's part of your income, which you have to add to your gross profit.
Understood.
Is it clear?
Yeah.
So it's possible that you can rent it out. So those are the advantages. Now we go to the problems about closing down. Overhead will still be paid. Closing it down or not closing it down. If you are expanding, you still pay the same overheads. Electricity, rent, insurance, you still pay the same amount. So why closing it down? The second point, contribution is likely to reduce because if that department is making gross profit, now you are closing it down. It won't be contributing to your fixed asset anymore. You get the point?
Yeah.
And the third one, loss of customer confidence. We talked about that. If you are shutting down a department, what about the customers of that department? They start having the bias mind over you, like, oh, this business is not reliable. Today they just shut down. Now we cannot patronize them anymore.
Yeah.
So it might affect other departments too. So these are the problems, these are the advantages and disadvantages of closing down a department. Now go to the advantages and disadvantages of expanding. It's an expansion, but it has its own problems too. So the first advantage about expansion is that it allows risk to be spread. It's about economies of scale. We call it risk bearing. You are able to spread your risk because now each department will be taking different risks. So if department A is not making profit, department B might be making it. That's why we have synergy. The sum of a whole is bigger and better than the sum of the parts.
Yeah.
That is what synergy means. So we can spread our cost, and if department A is not making profit, the profit of department B might cover up for department A. I think it's clear. Two, it might increase employment opportunity. Now that we are expanding, so we might employ more workers.
Yeah.
That is what we call social benefits.
Social benefit, okay.
Do you understand?
Yes.
That's about that. Then what are the problems about expanding? It might increase pollution.
Pollution, okay.
Yeah, because you are now increasing your output.
Yeah.
It might increase pollution. Yes. Two, overall increases through cost. Yeah, overall it will increase your cost.
Okay.
Because now if you have expanded, you would have employed more workers. Employing more workers means you have to pay more. Yeah. You might have need more equipment, you're paying more. Yeah. So it increases your cost. Overhead, yeah, it increases your cost. I think it's clear. Is it clear, please?
Yeah.
So we go to apportionment now. Activity 3. Are you there? You have something?
No.
Okay. Activity 3, we have apportionment. For apportionment, they said, how might the following overhead costs be apportioned? So if now we have different departments, How do we apportion all these items in the statement of profit or loss account? Depreciation. Depreciation is the value of non-current assets. So depreciation is part of your non-current assets. So you have to divide it based on the value of non-current assets. Done. Then we have rates for a building. A building has different floors. So it has to be based on the floor space occupied.
Yeah.
So what space is it occupying? What space is Department B occupying? That's what you apportion the profit or the items of expenses. Management salaries. For management salary, you can apportion it based on the numbers of employees in each department. That's the first way. Or the wages of each employee. Two ways there. Then we have general expenses. General expenses should be part of your revenue. It's a common sense thing.
Yeah.
Then we have property insurance, still based on floor occupied.
Sure.
But if that department is closing down, you have to spread the cost on other departments. Equipment insurance, value of non-current assets because it's an equipment. The value of the non-current asset. The marketing expenses, marketing goes to revenue too because when you are marketing, you want to sell.
Yeah.
So the expenses made, the marketing expenses should be distributed on the sales of the business. Clear? Any question about that?
No.
So that takes us to activity 4. So activity 4 is a bit technical and we're going to do it now.
I'll come one second.
You go to activity 4, meal antiques. So meal antiques has 3 separate departments: sales of antiques to customers, restoration of antiques for customers, and cafe. So we have 3 departments that we need to work on there. So we have the items here. So the following balances were extracted from the books of accounts of the year ending 31 August 2017. So we have the revenue, which we have to deal with first. One of the items. So the first thing is we prepare different departments. So we are preparing 3 departments there. So we have sales of antiques, which has a revenue for 135,000. We have restoration, which has a revenue for 45,000, and we have cafe, which has 30,000 revenue. Then we less our cost of sales. For cost of sales, we have antiques, restoration, and cafe. So it's 59,000. They give us the cost of sales immediately, so that makes it easier. So you just less it from it, 59,500 from 135,000 for sales, 10,000 from 45,000 for restoration, and 6,000 from 30,000 for cafe. So that gives us our gross profit, 75,500 for sales of antiques department, 35,000 for restoration of antiques, and 24,000 as gross profit for cafe. Done. Then we take all this away from our expenses. So our expenses starts from the wages there. So for the wages, for sales of antiques department we have 15,000, restoration we have 20,000, cafe we have 10,000. But we have additional information for wages here. They say wages accrued. Are you there? That's the third
Yeah.
one. Wages accrued at the year end: antiques 1,000, restoration 2,000. So we have to add it to the expenses on wages because it has been accrued. And remember, accrual matching concept. The liability of this year must be added to this year expenses together. So our wages department will be 15,000. So 15,000, which is for
Sales of antiques.
sales of antiques, we have 1,000, making 16,000 for sales of antiques instead of 15,000 to now be 16,000. Then restoration department will have 2,000 added to 20,000.
Restoration is 20,000.
Yeah, making 22,000. That's for restoration. So the wages now are 16,000 for sales of antiques, 22,000 for restoration. Cafe remains the same amount, which is 10,000.
What's the first one? Depreciation.
Depreciation, I'll go back there now. For depreciation, remember depreciation is, we have it in the second line. Are you there? So the first and the second line is what we need to use for depreciation. So they said non-current assets are depreciated at the rate of 20% per annum using reducing balance method. So reducing balance method is 20% of the original cost. The historic, don't use original, you use historic cost. So the historic cost is 27,000, right? Historic cost is are you there? Historic cost.
Yeah.
Yes, 67,000 for historic cost is there. Do you see there? Non-current assets cost 67,000. Yes. So we have provision for
So
depreciation.
You do it by 20% times 100.
No, before there's provision for depreciation, which you have to take away from the cost.
Okay.
There's depreciation, right?
Yeah.
And depreciation is the wear and tear of an asset.
Mhm.
So whatever the cost of that asset is, you have to take away the provision for depreciation. That will give you the value for depreciation.
Mm.
So I wrote it here for you anyway. Depreciation is cost minus provision for depreciation. This is
Yeah.
historic cost.
Yeah.
Historic cost of assets minus the provision for depreciation will give you the depreciation value,
Yeah.
which is 27,000. So 27,000 is what you use your reducing balance method on. Please don't forget that.
Perfect.
Do you get it now? Not 67,000 immediately, not 40,000. Provision for depreciation is an expenses.
Yeah.
Remember when we are doing our statement of financial position, cost, provision for depreciation will give us the net book value, NBV.
Yeah.
So the NBV is what you take your reducing balance method on. So the reducing balance method now is 20% of 27,000, which is 5,400.
100, okay.
So 5,400 is now what we have to depreciate based on apportionment.
Yes.
20% of 5,400 for antiques, 50% for restoration, 30% for cafe, 20%, 50%, 30%, 1,080 depreciation, 2,700 depreciation, 1,620 depreciation. This makes 5,400. Clear?
Okay.
So wages is done, depreciation is done. Clear?
Yeah.
So for management salary, we have our management salary to be 24,000. So for management salary, which is 24,000,
Here on point, before the last point, are pointed by the wages of each department.
So the wages of each department is known already to be. Wages for each department is
It is 24,000.
no wages 16,000, 22,000, and 16,000. Where is it? 16,000, 22,000,
10,000.
and 10,000. So that is what you divide by 2.
Yeah.
You divide by 2. So
Why
it's-
not 3 by each department?
No, it's divided by 2 because we don't have a specific number for the numbers of workers here. We don't have.
So you don't want to divide by.
Yeah, look at what they said. They said, look at back to the question.
But
The
look what it
addition-
says. Management salaries are reported by the wages.
apportioned by the
by
wages
each
of each department.
department.
Yeah, the wages for each department are this.
Yeah, you have
The
one,
apportionment
two,
is
three
divided by
departments.
2.
But why not by 3? It says each department here. Though.
Yeah, you are apportioning. So whatever you are apportioning will be divided by 2. That is how you. It's a management salary. In as much as you don't have, you're not. It's not floor. If it was floor, you would use the square meter, which would be ratio. But for the fact that you don't have a stipulated amount, whatever the salary of management are, or whatever the salary of each department are, they are paying half of it for manager.
Okay.
Do you get it now? But if we have numbers of workers used, then you use a ratio. So if it was 10 employees for antiques, sales of antiques, 30 employees for restoration, and 5 employees for cafe. So it will be 10 ratio 30 ratio this. That will be 1 ratio 6 ratio 2.
Oh.
So it will be 2 plus 6, 8 plus 1, 9. It will be the total revenue over 9 multiplied by 2, multiplied by 6, multiplied by 1.
Fine, okay.
But if you are not given, you divide by 2.
Okay.
Put that in mind, please. So 2 divided by wages by 2, that's 8,000, 11,000, and 5,000. Clear? So we go to eating and lighting. For eating and lighting, we have, it was given here, they said, eating and lighting, the amount of eating and lighting is 4,500. Then we have to check additional information for apportionment. Eating and lighting, rent and weight, insurance are apportioned based on floor space.
Yeah.
So our floor space is 1,400, 200, and 200, which is 1,400 ratio 200 ratio 200. So we divide by 200. 200 divided by 201, 200 by 201, 200 by 1,400, 7. So the ratio for eating and lighting, the ratio for insurance, the ratio for rent is 7 ratio 1 ratio 1.
Okay.
So now 7 ratio 1 ratio 1 will be used for the expenses. The value for eating and lighting, the value for rent and weight, the value for insurance. So we're starting with eating and lighting. The value for eating and lighting here is 4,500. So it will be 4,500 with the ratio 7 plus 1 plus 2, 1, that's 9. 4,500 divided by 9. That's the addition of all the ratio. It's 500. So we now multiply 500 by each ratio. 500 multiplied by 7, 3,500. 500 multiplied by 1, 500. 500 multiplied by 1, 500. Is it clear?
Yeah.
Done. Rent and rate. The value for rent and rate is done. It's 9,000 divided by 9, which is,
Based on the floor space.
yeah, divided by 9.
Which is
1,000.
4,400.
So 1,000 times 7,
No,
1,000 times,
1,400.
yes. So is it clear?
It says 1,400.
Rent and rate.
Floor space, antique sales, 1,400.
I said we did it already. Did you read the case study, please?
Mr.
Go
Rent-
back to the case study.
It says rent and rates. You said 9,000.
Hello? Look back to the case study.
Yeah.
We already did the floor. They said the floor space. They said rent and rate, eating and lighting. The fourth additional information. The
Based
fourth.
on floor space.
Yeah, we did the floor space already. So we're going to use 7:1:1.
So it's gonna be 1,000. Okay, 1,000. Okay.
When I was, please always focus on what I'm doing there. When I did the ratio, I told you we're going to use this ratio for eating and lighting. We're going to use this ratio for rent and rate. We're going to use this ratio for insurance.
Perfect.
That was what I said
Okay.
earlier. And having said that, we started with eating and lighting. Well, the value for eating and lighting is 4,500. You divide it with the ratio, then you multiply it with each ratio.
Okay.
Insurance is going to be the same. The value of insurance divided by 9, multiplied by each ratio. Rent and rate, you divide by 9. The value of rent and rate divided by 9, multiplied by each ratio.
Okay.
So the floor space is given. You can't multiply. This floor space is there.
Yeah.
You are supposed to use your accounting knowledge to make it a ratio.
Yeah.
I think
Alright,
it's
yeah,
clear
I
now.
understand,
So that is the point there. So rent and rate is done. 9,000 divided by 9, 1,000. 1,000 times 7, 1,000 times 1, 1,000 times 1.
Okay.
7,000, 1,000, 1,000. I think it's clear.
Yeah.
Advertisement is apportioned to all departments, which is the cost of advertisement, which is 5,600. You divide it for each department at the ratio. So it's going to be divided by 7, which is 3,600, divided by 7, 1,200, divided by 7, 800.
Yeah.
Clear? Then we have, that's advertisement done. Then we have delivery expenses. Delivery expenses is 2,000. It's apportioned on sales too.
Yeah.
We divide it the same way. We have delivery expenses, which is 2,000. That means each department will have divided by 3, 1,500 divided by 1, because it's 2,000.
Yeah.
1 ratio 3. 3 ratio 1, sorry. So 500 and 3 times 5, 1,500.
Yeah.
So that gives us our 2,000. Then insurance. Insurance is 3,600. 3,600 divided by 9.
Mm-hmm.
That is 3,600 divided by 9. I did it somewhere here. 3,600 divided by 9. That is 400. Insurance. 400.
400.
400. Then the amount left. 400 plus 400 is 800. 800 minus 3,600 is 2,800.
Okay.
Is it clear? Because we said it's 7:1:1.
Yeah.
400 times 7, 2,800. 400 times 1, 400. 400 times 1, 400. Is it clear?
Mm-hmm.
So the cost of sales are now, our expenses are for sales of antiques department is 43,480. For restoration antiques, 39,300, and for cafe is 19,320. Then you take it away from the gross profit. So the only department that is making profit here,
The last one.
yes, it's sales of antiques department, which is 32,020.
Yeah, last one.
Restoration is making a loss of
Loss.
4,000. That's why I use the red pen. And cafe is making a loss also. No, cafe is making a profit.
I said your last one is making profit.
Yeah, sorry. I have to use a black pen there. 4,680. So we only have only restoration of antiques department that is making a loss of 4,300. Is it clear?
Yeah.
Any question about that? So that ends activity 4 and chapter 12, accounting, departmental records.